Friday morning. Welcome back to Real Estate Mindset. We got a lot to talk about today. I was going to go over the mortgage report first, but I think it's better we talk about the stock market, being it's absolutely on fire. And I just wanted to say once again, you guys, happy Friday. Thank you for joining us today. Everything will be chaptered in the description if you guys want to come back and watch this video. Got a lot to report on. We're going to end the video by giving you guys an update on the Discord and Teachable community that we are making. We're very excited to roll that out. But first, I just wanted to say good morning to you, Mitch. How are you?
Good morning. I've been watching the market since about 2 o'clock this morning, and it has been straight down, nonstop.
It's so bad. Just wanted to say good morning real quick to Merlin. Good morning. Thank you for the date. That's yesterday's date. You must put that last night. Les, where are you at this morning? I haven't seen you. Good morning to Red as well. Good morning to Vincent. We definitely appreciate you guys. Can't wait for market open either. Now, what I'm going to do is I'm going to start us out with a market update. I was going to, again, go into a mortgage update, but there's just too much going on right now not to cover that first. Good morning, Vovo. How are you? There is blood in the water. I can see it very, very clearly. There's Les. There's Joey. Definitely appreciate you guys. Let's get started on the market report right now. Let me throw up this on the screen real quick because I want to show the viewers the first thing, which is the futures, because yesterday we had a horrible day on the stock market. You guys can see that the stock market is going to open up as well. Pretty horrible. Dow down. Is that 1,320? Yeah, it's 1,320 points right there. Absolutely incredible. Now, Mitch, you were saying right before I hit, record on this video that you may have to go soon because you may want to put some short bets on this market as soon as unemployment comes out. Is that correct, sir?
Yeah, it's unemployment comes out at 7:30 this morning. And so the market will probably lift up a little bit. And the second that report comes out, it'll slam right back down.
Okay, so if we're going to watch some videos today, if you wanted to put in some bets as we're watching the videos, by all means do it. And let us know what you decide to do, because I'm sure people want to know how you plan on making money when the stock market is melting down.
Surprisingly enough, on days like this, it's actually fairly difficult because the size of the bar, like on a 5-minute bar, it's almost 100 points. So if you're trading the minis, that's $200 for one contract on a 5-minute bar. You better be real careful what you're doing.
Yeah. Oh my God, man. I mean, it's finally happening. We have so many recessionary indicators now. It's not even funny. We're going to see prices go down. We're going to see interest rates go down. But let me start by giving the viewers an update on the market. Here is the 10-year treasury right here. It's under 4%. I mean, we were just talking about this on Monday, and I was saying like, wow, we're still over 4%. That's interesting. But today, you guys, we finally are under 4%. That means that interest rates on mortgages, on at least FHA, it's going to be under 6%. So when interest rates update today, you're gonna see an FHA mortgage on average being under that 6%. But right now, again, the absolutely phenomenal. The 10 years plummeting. So 3.9% down, 12.5 basis points. That is a big swing. And let me go into the market real quick, starting with the VIX. Holy smokes. Look at this, guys. So I've had a lot of people say, we're not going to go into recession. You're crazy. The VIX has to get to $40. It always gets to $40 before recession. And I'm like, what about median household income? Doesn't that matter? And also the VIX is reactionary. So guess what? We're at $40 now. We're at $43. The VIX is up pre-open. It's up 43.47%. I want you guys to think about that real quick. And that's reacting to the market. That's not predicting a recession. That is saying, oh yeah, it's already here. So VIX 43.07. Let me show you guys gold. Gold is basically sideways today. We hit a record, I think, this week on Monday, Mitch. Is that right?
Yeah, 3,200. Yeah.
So we hit that record, I think that, but Monday, gold is, again, it's sideways today. Let's keep going. Holy moly, right? I mean, wow. So this is a little bit of good news, Mitch. Oil's down 8.2. Like oil was down yesterday. It was down yesterday pretty hard. So it being down 8.23% today, that I believe has a lot to do with the production of OPEC saying they're going to do what, 3 times more than what they thought. What's the reason for this decline in oil? Does it have everything to do with OPEC, Mitch?
It's just supply and demand. That's all it really is. And there isn't anything anybody can do about it. It's moving under the theory that, well, the markets are slowing down globally. We can debate the reason why, fraud. But the point of the matter is the markets are slowing down. If the markets slow down and you have excess inventory, then the price is going to drop, and that's what you're seeing.
Well, they definitely have some excess inventory then. All right, let me show the viewers real quick what happened to the market closing yesterday. And if you guys can give us some questions, I'll go to your questions at the end of this segment. We're almost done with it. But the Dow Jones ended yesterday down a whopping 3.98%. I just wanted to show you guys kind of just the year to date and over the last month. So over the last month, not even counting today, the Dow's been down 4.77%. You add today's future in here, it's going to be down almost 10%. Just depends how it ends. Here's the S&P down 4.84%, 274 points yesterday. So it closed in the gutter yesterday. I showed you guys the futures. Let's see if the futures have changed here. So the S&P down another 180 pre-market. You guys see that right there. I mean, it's absolutely spectacular chaos in the markets right now. Hopefully people have been paying attention to what we've been saying, and now will take us a little bit more seriously if they haven't already, even though we're just kind of using simple math. Look at the NASDAQ, Mitch. Holy smokes. NASDAQ ending yesterday down 6% in one day yesterday. Absolutely crazy. Let me see what the futures are for the NASDAQ right now. 666. Look at that. So down 666. I mean, just absolutely spectacular chaos. We're going to go into a video here in a second. But if you guys had any questions about what's going on, go ahead and let us know below. And Mitch, while I'm teeing up these questions and this video, do you have anything you want to say about what's going on in the market right now?
Shoppers.
The red tags are up and
Silver's down about 15% from its high. It's under stress. If somebody was interested in buying, you might want to be looking. And everybody say, "Oh, now the sky is falling." Yeah, it'll fall for too much longer.
So you're thinking maybe we should get some silver? Is that right?
Yeah, I'll be shopping on Monday.
You gonna be shopping for some silver, Mitch?
Yeah.
Okay, I appreciate that. It's not financial advice. I was just curious what you're doing. I definitely appreciate it. Let me see if we have any questions right here.
It's a pretty big downdraft. I mean, you're about 15%. That's pretty good.
So here's the only question I can see here from my buddy Les. And you remember Les? He was the guy that said price is the only thing that matters. So at least he's asking I mean, he said payments is the only thing that matters. I was like, Les, no, price is what matters more. So his question is what mortgage rate would I get into a house with the deals that I've seen? So I've been telling people I've been able to find homes in my housing market, and I'll show you guys at 2020 price points. But the problem is when I do the cash flow and I do the work on the payment, it skyrockets upward. So for me, Les, it's not as much about the interest rate as it is about simple math. I don't care if the interest rate's 7. I don't care if the interest rate's 2%. When the math works, the math works. And what I'm talking about is many things, not just the wedge, not just the cash flow, but also that I love the house and I could comfortably afford the payment. And I understand and I've defined what affordability is. But I will say this, the lower the interest rate, the lower the payment. It's just the problem, Les, is the prices are so high over the last 4 years that a small decline in interest rates of a point even, it's not really that big of a difference. And we also see that when we look at the demand, and we'll look at that here in a second. Here's one more question right here, and then we're going to move on to this video. And the video is going to be a bond report on how yields are falling along with stocks. My camera's overheating. That's different. I've never seen that before. So question, Mitch, is this Black Friday for the market? What do you think, buddy?
It could be, depending on the unemployment report. So we'll see how all this plays out. But the market is down in the last couple of days severely. And these things have to occur because the fraud is coming out of the system. It's going to be rough. There's no doubt about it.
It is going to be rough. Good morning also to Noel. I appreciate you. Always nice to see you. You've been a supporter of the channel for quite some time. Let's listen to this first video right here from the Talking Suits, which you guys, listen, I know it's a complete waste of time. Mainstream media lies to us. Their data is all about methodology, and methodology creates biasness. They're not using raw data. But let's listen to what they have to say. Now, this video was done yesterday before futures came out. So let's see if they're over optimistic. And if you guys can, please, pretty please, with the cherry on top, let me know that the audio is good. I just wanted to make a chapter in case you guys come back here. I'm going to mute us right now, Mitch. Enjoy the video. And again, you guys, don't forget to let me know if the audio is good.
Alongside stocks just above 4%. Rick, you just heard the inflationary, deflationary comments. Comment on that and comment on this. Is there any part of you that believes that come hell or high water, the president wants lower rates, and he's damn well going to get them, even if it means breaking parts of the economy?
You know, on the latter, I hope not. Okay, I can't get in the president's head. And even though his Treasury Secretary on CNBC pointed out that he wanted lower rates, and they have gone lower, I don't think that's the way they wanted to get there. And in terms of inflation or deflation, I think it's pretty simple. Globalization was deflationary. Reversing globalization will be the opposite. Now, it doesn't mean all timelines are going to confirm that, because some of this is just a trade. Many are trying to peg all these moves in a cerebral way with very complicated fundamental or economic thesis, but it's not necessarily the case. Sometimes it's just many individuals, many institutions, many investors getting out of long-term trades, and the market gets jostled around. With respect to the globalization, this definitely sped deglobalization along. But in my opinion, it was going to happen one way or the other. So you either tear off the Band-Aid in a quick fashion or you let it fester over time. Because after the 40s and World War II, when the U.S. economy was so far ahead of all the other economies that we didn't care if we made good deals. We didn't care if we helped the competition. We helped the Japanese, the Chinese, the Europeans, because they were so far behind. If it was a race, we couldn't even see them. But times have changed. Now we compete. And when you compete, it's not that they're not allies in a cultural way or allies in a way of benevolence. Of course they are, and that hasn't changed. But we compete. And anybody who's been looking at some of the rhetoric between China, the U.S., the Europeans, the U.S., the people that are into more green issues in the U.S., and all these, we could see that there was a uniform elitism in globalism that many in the United States didn't like, and in many countries they didn't like. And that divorce is going to cause lots of instability. But we're not going to be able to really see the details for at least a quarter or two. None of this is going to catch up with the markets and the way we measure the economies in a very quick fashion. But I do agree with our one guest who said that most likely the markets are going to get used to this in a much faster time frame, and I think cooler heads will ultimately prevail.
Rick, can I ask you a couple of tactical questions? What do you think happens with the 10-year from here, and what do you make of the dollar weakening?
You know, see, here's what I think. I think all the conventional wisdom about what was going to happen, I never put much confidence in it. The thing I put confidence in is, for the moment, the only hedge against nervousness in stocks is going to be the Treasury market. Will that be forever? I can't tell you that. In terms of the dollar and Treasury rates, look at my charts here. Everything goes back to October. And when I see that kind of symmetry, it doesn't make me nervous, because many of these correlations have not broken down with the volatility. In other words, 2- and 10-year yields are on pace to close at lowest yields in 6 months. If you look at the dollar index, the dollar yen, the euro versus dollar, the pound versus the dollar, they're all comping to early October, every single one. That gives me some confidence that there's a certain part of this move that, as fearful as we may be with volatility and uncertainty, there is not necessarily an instability to what is going on. Right. And what's more, if you look at the major low in the dollar index from April 22nd, 2008, that was a 40-year low in the dollar. If you look at that chart, it's my last chart, what you'll notice is, other than the last 4 years, we have not spent a whole lot of time above 100. So to me, there's a lot of mean reversion going on in foreign exchange that I wouldn't worry about.
Okay, I got some questions here. I want to try to help answer here for you guys. I'm going to tee us up. Excuse me. I'm going to tee us up for our mortgage update. But first, I like this one here. This is interesting. This is full of some stuff. Now, Mitch, I want you to try to answer this, but remember, it's full of traps. Okay. In other words, don't get political, brother. Don't you do it. Don't you do it. All right. So here's his comment. This will be a recession with rising prices. So people are going to be losing their job. Their incomes are going to go down, but the prices are still going to go up. The worst possible outcome. Trump has blundered. Mitch, calm down. Trump has blundered into disaster, And he's saying guns and butter, people, guns and butter. I can't argue with the guns and butter part, but what do you think about a recession with rising prices at the same time?
It's likely, but it is what it is. See, that clip you just showed, it's full of problems. And it's not that what he's saying is disagreeable. It's that the framework from which he made it is incorrect. And if you go and look at the creation of the European Union, they stubbed out their culture to China. If you look at what has happened in the United States, they stubbed out their culture to China. So he admitted that. He just didn't use the correct framework. Well, when that happens, American jobs leave the American shores. When that happens, the ramifications of the Federal Reserve offsetting the damage from the stupidity of eliminating those jobs on the American shore is the framework that this needs to be looked at. The Federal Reserve has done nothing but create fraud since the day it was created. And if you don't look at these things with the correct set of lenses, and you come to the wrong conclusion. The facts play out in reality. The problem is it's the fraud in the system. And it's created at two levels: the Federal Reserve and your local real estate taxing entity. When you look at the outstanding US debt, they cannot be paid off. We have the unfunded liabilities, and you have the what they believe are current national debt. Okay. The combination, let's call it, for the sake of conversation, and I know I'm wrong, I know I'm conservative, let's just call it 160 trillion between the two of them. There's no math on the planet that can pay that off. Second issue is, we've already proven, because that document is in the hands of the DOJ, what happened at the local real estate taxing entities, that they've created 5 trillion worth of bond fraud. Well, that can't be paid off. When you have societies, Argyle, Texas, with $343,000 per house in outstanding school district fraudulent bond debt, under what scenario on this planet can that be paid off? The answer is it can't. Well, that comes right back to that video clip you just saw. If you don't look at it through the correct lens, and the lens must be who created the fraud, who got the benefit of it, and how are we going to get rid of it, the ramifications then become, why are we having rising prices? It's a knee-jerk reaction to a problem that's been created over a few decades. And now it's going to come out. It has to come out.
Let's look through the lens of imagination just for a second here. And I have one more question. We have to hurry and get to the next segment. But from the Italian Stallion, Rocky, by the way, great movie, Sylvester Stallone. Don't know if you've seen that. It's a good one. But what he's saying is if Mitch, if Mitch were president, what policies would you implement to bring down the deficit?
Let's look at it this way. What you have right now today that's verifiable and provable is 7.1 trillion worth of outstanding school district bond fraud in the system. And if you say, okay, fine, 15 cents on the dollar is legit, okay? Because there are certain laws that says a school district can go and raise bonds, but let's just call it 15 cents on the dollar. Well, that's going to give you $5 trillion that can immediately come out of the system, because you see, the money was never real to begin with. And that's part of the fraud. So you would say, well, a school teacher paid into that system. Yes. So let's say they put $25 in, but over time, that $25, because of the compound cumulative fraud that has been created against mom and pop, well, when they jack up the values that aren't real, and they go and print money to offset those values that aren't real, that's the fraud. So if it was me, I would be taking a blowtorch to Morgan Stanley, Vanguard, Fidelity, anybody that sold this crap. I would destroy the school districts without exception. Superintendents, school superintendents, claw back their pays.
Whoa, Mitch. Whoa. Easy, buddy. Man, people get polarized when we talk about the public school system. You know, and it frustrates me because the same people are saying, no, we love the school system, protect the children and teachers. That's
But
what
they're
we're
not.
also saying.
But that,
I
but
know
that,
they're not.
yeah.
Yes. They're just not looking at it through the right lens, which is what you're saying. Sorry,
You've got to go, you have to stare at these things through the lens of fraud, because you will not put mom and pop back on an even playing field where they own their balance sheet. They own the land beneath their house. If you do not eliminate the fraud, you keep the fraud going, it will blow to shreds. I mean, it's just the way the math works, because they don't have the money. You can't get blood out of a stone. Okay. And at what point, if you can't get blood out of a stone, what are you going to do? Put everything everywhere into bankruptcy? That's the exact opposite of what you want to do. You want to save the system as best you can. You don't want to let it implode, but it's going to implode if you don't get the fraud out of the system.
You know, Mitch, I would be super flattered with the question. If you guys want to ask me if I was president, what I'd like to, anytime you want to ask that, I'd be happy to answer that question. What a flattering question. Am I right? Like, hey, if you were president, what would you do? People respect what your answer was. Respect.
Well, like the people that sold this crap, that didn't do the due diligence and just assumed that mom and pop would pay this off in perpetuity. These guys are smart enough. There's no excuse. This is the Vanguards of the world. This is the Morgan Stanleys of the world. They hauled into the White House, sat down, literally say, you got 5 minutes to make a decision. You're either going to do it as we are requesting, or by tomorrow morning, your company will be gone.
Mitch, you're this close to being too honest with people. All right, let me move on real quick here. Couple things real quick from Monica. Monica, yes, we are still looking for moderators. I'm going to get to that towards the end of this video, but we still are. And then just the last question, Mitch, and let's quickly go over this so we get into the mortgage update and I can show people what's going on with rates. And this is a couple of people saying this. They're saying Monday could be the biggest crash in decades. Do you agree with that sentiment?
Wait for the unemployment report to come out.
It depends on the unemployment report. That's fair.
Well,
all right, that's
we're hemorrhaging here, right?
Yeah.
So if the unemployment is really bad, this thing is like, and
yeah, I wonder how many people are going to be bamboozled by themselves by keeping their head in the sand this whole time.
Yeah.
Hopefully not many, but I fear it is many. So let's move on to the mortgage update. We're going to do that right now. You guys keep your questions coming after the end of the segment. We'll go back to your questions. Let me switch this up real quick. So here is the mortgage report. Let me take this comment off the screen so we can see a little bit more of that. All right, so here's a mortgage report, you guys. This has not updated for today yet. Now, remember, this is what it's going to update. Okay, so it's going off this 10-year. You guys know that. The 10-year's down 13 basis points. If that continues that trajectory, you're going to see what I'm circling right now. This is the FHA interest rates. You're going to see this under 6% today. Probably around around noon or something like that, but that's going to update today. Interest rates are going to plummet, but right now we're sitting at 6.63. Again, that's going to update as well, probably more like 6.55 or something like that. You'll notice as well that FHA has a lower interest rate, actually substantially lower by about 60 basis points versus conventional up here. Now, again, I want to remind you guys, when it comes to getting a mortgage, you're going to want to shop your mortgage with different lenders, because what interest rate is really about is pricing. Pricing is the fee associated with the interest rate. And by shopping and comparing loan estimates and comparing interest rates, you're able to get yourself and secure yourself a better deal. And you can do that because generally when you have a mortgage lender or broker run your credit, you have an inquiry with a grace period of 30 days, meaning you can continue to run your credit report with mortgage industries, not car, not credit card, mortgage industries, and not have an additional credit score ding. So make sure to shop your mortgage and understand as well, generally a broker is generally cheaper than a direct lender, but you won't know that unless you do the due diligence to shop. But here's what it is right here. Let me go on to the next thing, and I want to show you guys demand. So interest rates have I really appreciate that. Don't move was this is who was texting me this morning when we were doing our Challenger report video. We've already done a video, you guys. We got up at like super early, did a video and then this live, but this is the guy. This is Austin. Austin was texting me how the market was melting down. And I'm like, he's like, finally, after 3 years, Travis, finally. And I'm like, I know, brother. I know. I feel that joy with you. But going back to the actual demand, and this is important to understand. So demand isn't, and it hasn't been keeping pace with inventory. But the problem is inventory has been so low, we really haven't had any price corrections except for places maybe like Austin and off shots like that. Obviously, Florida is deteriorating as well. But I'm showing you guys that even though interest rates have gone down, this is the purchase index that Mortgage News Daily is creating, and it's a composite index, so there is methodology here. But interest rates going down, you can see about a half a point, about 30, what is it, about 32 basis points, and demand is essentially gone down. So interest rates went down, and so is demand. We're going to see more than likely this go up when it comes to this right here, which is your refinances. And you guys can see as interest rates go down, refinances go up. And that is a bad thing. We should not be refinancing our houses. We need to be paying our houses off so we don't have that giant mortgage. That is one of the best things we can do right now, is get out from underneath that mortgage debt. I'm not going to go over an amortization schedule today, but another problem with the housing market is this, you guys. So we have a record high housing payments as well. So even if mortgage rates go down another 20 basis points or 10 basis points today, it really is not going to impact us much, because those prices are so high, especially when we include property taxes, homeowners insurance, and costs like homeowners associations. Now, right now, this is saying that the new record high, so new record high as of, what was it, yesterday, so Thursday, was $2,803. So in other words, you guys, the housing market is absolutely cooked. It's going to take some time depending on the market. In markets like Florida and Texas, we already have more inventory than we did pre-pandemic. In fact, the nationwide inventory is over pre-pandemic, at least February of 2020, when we add new homes. So when we add existing plus new homes, we have more inventory right now. So demand was not able to keep up. And guess what, you guys? We're going into recession. So I'm saying prices are going to go down. But do the math. Use the math. Localized subdivision is important. I'll show you guys that in a minute. I'm going to queue up our video right here. Let me see if we have any questions we can take. And our video is going to be about mortgage rates tumbling and potentially what that may mean for the housing market. So it's a pretty good video. Let me see, though, if we can get any questions here. Anyone have any questions? Want to give a thank you real quick to Austin. So Austin's in one of my videos. He actually found the abandoned new home community. This is the man right here. This is my buddy. I've been trying to get him to join my search and rescue team, which I haven't been talking about recently. I haven't even given people an update on Hurricane Helene. Mitch knows why. I've had to step out of that here a little bit, let the dust settle because of some really evil things, literally evil things that have been happening out there. And it breaks my heart to not report on that, but that doesn't matter. We'll go over that in a minute. Actually, I don't even know if we'll ever go over that. I want to. Mitch knows. Mitch, I want to get political right now on these people over there, and I want to tell people what's really happening, but I'm going to hold back. So here's something from Wally. It's going to be a bumpy ride. Be prepared for big swings. Having swing puts control in Wall Streeters as top. Oh, I'm sorry, at top. They are just salespeople making huge money on fees. Yes, on the uneducated American sheep. One of those we should lump a pension in that statement. Because once someone gives into their pension or 401k, they essentially don't know what's going to happen. They just set it and forget it, like that. Was that George Foreman grill? Nah, it wasn't that. What was that? Set and forget? I can't remember. But my point is, Mitch, my point is this. What do you think? My point is I'm going to defer to you. Is this a good comment? Do you feel like he's on point here?
Yes, because all these things are connected. The employment that we spoke about before and the economic cycles, right? People get laid off. And could you imagine the scenario if the fraud wasn't in the system? You would have normal business cycles that take decades to play out, and your gyration of people being fired would stop. So every time these economic cycles get shorter and shorter and shorter, then the employment gets faster. In other words, the turnover. The shorter the economic cycle, the faster the turnover of the employees. Well, it's all correlated and it's all tied to the fraud. So eventually in the markets, what happens, the markets are a little bit disconnected from somebody being unemployed. But what we have to see in the market in order to denote what the real true bottom is what's called capitulation, which is just an absolute flush that looks absolutely horrific. And it's designed to that point to scare the children. And when it scares the children, that's your capitulation. That's what we have to have happen.
I guess I should, I started to laugh like, scared children. But really, man, I'm so fed up with people getting bullied and lied to and manipulated. It makes me so mad. And then I'm also frustrated that those same people attack me as if I'm the one that's the problem when I'm the one who's trying to, we're trying to enlighten them and help them and say, hey, let us give you another perspective, because historically we're going to head straight into a recession. The reason why it's been taken so long and people are like, oh, the price is this price, that is the inflation. It's the Federal Reserve and property taxes and we can go into the Federal Reserve, but I'm not. I got to move on. I want to, Mitch, very badly.
There is one point. There is one point to all this, though.
Go ahead.
If everybody out there goes and reads the First Amendment to the criminal complaint and truly sits down with an espresso and gets through it, you will know more about economics than anybody in your economic sphere, in your immediate sphere combined. And that tells you where the truth is, because that lays out the case for fraud.
Yeah, it's really good. And if you guys want to know where that's at, you can go to the Real Estate Mindset Empowerment Center. I'm going to go through that at the end of this video. It's a teachable platform. We literally have everything is free. We want to be those guys, right? Like here it is for free. Don't listen to these crazy psychopaths that just want to make a fee off of you. All of that fat in the middle. So this is from Nikki. Just two questions. We want to be fast. Nikki is saying, is the 10-year note crashing a good indicator of an upcoming recession? What do you think, Mitch?
No, we've been in a recession for at least 2 years.
It's reacting.
The press is wrong. What you're just starting to see now float to the surface is the ramification of the fact that we've been in a recession. Most indicators are lagging indicators. The press is so far lagging, I'm embarrassed for them. I mean, there's no other way to say it. So
just like this. This is also a lagging, like, oh my God, the VIX is at 40. We're going into recession. Like, no, you guys, it's saying we're already in recession. It reacts to the market. It doesn't indicate. Like the 10 and the 2 is a good indicator, or even government job. I mean, all the stuff we've been talking about. Here's another comment. I'm interested to hear your opinion on this. Now, he's asking, this is Art Caffeine. He looks like he's had some caffeine. I wonder if you have a YouTube channel. If you do, I like that profile. I think everyone should be on YouTube. The more people on YouTube, the better. I don't like to see grifting, people that don't understand what they're doing, but nevertheless, we need more people on YouTube talking about the truth, offering more perspectives. He's asking, when you say home prices will crash, are you thinking of a 2008 dump, which is essentially went from 2007 to 2010, actually. So it was kind of like 2.5 years. And I'm going to be honest with you here. So now that I have seen the reaction and I understand the greed, corruption, and fraud and how inflation works, I'm gonna answer that by saying it really depends on what happens with quantitative tightening and if banks are going to be bailed out and things like that. But assuming it's only going to be mild, which it might not be, I believe that home prices will go down more than 2008. I believe that for two reasons. Number one reason is the PE ratio, or the price bubble when compared to median household income, is higher. It's actually much higher than the peak of the global financial crisis. So you have a price bubble by any standard when looking at income. The second thing is the national payment to income ratio. So meaning that even if prices go down, the payments are still too high. And it's not just because of the price. Payments are too high because property taxes followed the fraudulent overvaluation. So property taxes is going to take 2 years for property taxes to update once home values go down. You have homeowners insurance problems. So you have payment and you have price, and you have a highly leveraged economy once again, and you have foolish people that think that the loans these days are super good loans. But the reality is Fannie Mae and Freddie Mac is just the long arm of the Federal Reserve. And you guys, Fannie Mae and Freddie Mac has allowed us to get in this situation by overriding debt to income ratio on qualified mortgages. Qualified mortgages were created through the Dodd-Frank Wall Street Reform and Consumer Protection Act. Qualified mortgages was really important. It stated debt to income ratio. Well, they changed it, but debt to income ratio cannot exceed 42%. They've been going 56% from the beginning. And when you ask, how did they get away with that? Isn't someone supposed to do something about that? Yeah, someone's supposed to do something about that. But it gets even worse than that, because not only was nothing done, Fannie Mae and Freddie Mac, which is arguably owned by the Federal Reserve, just bought the paper. So they knew there was fraud, Mitch. They knew that these loans had too high of a DTI, and they bought the paper anyways. How's that possible? That's been happening the whole time. So my point is, guys, although it's nothing compared to subprime, I will never say that loans these days from a income verification point, it's nothing near as bad. But when you look at unaffordability, it's worse. And they want stated income. So it should be a lower debt to income ratio in 2008, but it's not. It's the same debt to income ratio. Why did we crash last time? Was it because of subprime loans? Maybe a little bit, but the primary reason is because people could no longer pay their mortgages because they couldn't afford to. It was an affordability thing on top of a speculation thing. So investors started selling like crazy and things of that nature. Anyways, so let me move on to the next thing. What do you think, Mitch?
On a percentage basis, it'll be worse, a lot worse.
And why?
The fraud has been built up. It's cumulative compounding. The fraud's got to come out of the system. And let's try a mind shift for a second. If you look at a house, you want to know when the value, I'm kind of reading between the lines here, but if you want to know when the value is right, you literally could look at any house, put a pro forma on that house together as if that house was going to be rented, take into account the fraud that's being created at the school districts and the local central appraisal districts, run that math into your valuation, and you will see that the net result is that what they've done by the mortgage-backed securities of all these houses is, again, blow up another fraud. And that means you're right back to the problem that we had in 2008 of the mortgage-backed securities that were, by all definition, pure junk. Well, I said that the outstanding school district bond debt is worth somewhere between 13 and 30 cents on the dollar. That's 70 cents. It's going to come out of this system. So if you look at a house and say, I'm interested in buying this house, and you say, well, it's 28 debt to income ratio, 28%. No, it's not, because the 28% never took into account the cumulative compound effect of the fraud.
Yes. Yep.
The real number is probably closer to 21 or 22.
That's
so
right.
Between running a pro forma to get to the real value and saying, I, as a buyer, have to be able to stomach the complete fraud, and it's irrefutable. Go and look at the document that we sent to the DOJ. That you as the buyer have to be able to stomach that.
Yeah.
What is that house really worth to generate an economic yield? Put the pro forma together, then you get your answer. Forget all the noise that's out there. It's not relevant.
I mean, if you're a homeowner right now, you're getting robbed.
Yeah.
And I'm going to show them on our housing market and real estate update. I'm going to go into MLS and I'm going to show them another property I found that's crazy overassessed. I mean, literally in our market, in mine, I'm just going to speak from my own backyard in Harris County. I can prove to any politician, I've been watching the politicians, this is why I'm saying this. I can show them right away. All you have to do to show the fraud, because they failed this when they're in the Ways and Means Committee and they're grilling someone, just show them an active listing compared to the assessment value. That's all you have to do. When you have demonstrated that, it's done. Case closed. They overvalued the house. Here's proof positive. And I'm not talking about a little bit overvalued. I'm talking some homes, 6 figures theft. Clear. We could show it. Simple math. It's just, they're not listening to us, Mitch. It is what it is. Let's go into the video. All right. I'm going to put that timestamp for that video at 38:40. Now, this video is on mortgage rates tumbling. And if you guys can, let me know. Oh, my gosh. U.S. payrolls, rise by 228 in March. But unemployment increases. Oh, unemployment is going up. That just came out right now. Let me just pull this up so I could show you guys, and then I'll tee up that video. So unemployment did come out, Mitch. Here it is right here. So U.S. payrolls rise by 228 until those revisions are done. Maybe there won't be. And unemployment did increase to 4.2%. Very, very interesting. I'm looking forward to unpacking that here a little later. Here's the video I'm going to play for you guys on mortgage rates. Let me put us on mute. Let me know that the volume is okay. And also, if you guys can comment below, did you like the Alicia Keys intro? Let me know about that. No one's said anything about Alicia. I think Alicia Keys is great. Let me know what you guys think. Here's the video.
Sales showing some life in Feb, up 2% after sinking 10% in January. Supply also climbed to the highest level since 2007. That's interesting. And prices fell 1.5% from the previous year. My next guest says staying put and remodeling seems to be making a comeback here. Joining us to discuss is Brown Harris CEO, Stevens CEO Bess Friedman. Bess, it's good. I love the blouse. Good to see you. Welcome.
Thanks so much. So good to see you, Kelly. How are you?
Listen, people, I keep hearing this refrain as well. A lot of people feel kind of frozen, stuck in place, like they can never leave their mortgage and so forth. So how is this shaking out so far for the spring selling season?
Yeah, I think that lock-in effect that we know about has had a huge impact, and people listing their homes and then buyers not having enough inventory. So that's created a sort of gridlock, which is not ideal.
Yeah, no, I
And
can.
so it's going to take a little bit of time.
Yeah, especially if you're a realtor where your business is kind of in the turnover. So, we can all sit around and say, hey, Home Depot, positive comps for the first time in 2 years, and people are spending on appliances and all that, but doesn't help you guys.
Doesn't help us at all. I mean, I think the new administration's potential tariffs have also created a little bit of stress in the marketplace.
Well,
It creates uncertainty,
a little surprised.
which is not good.
Is that because you're in New York where people tend to be much more geared towards kind of the ins and outs of policy, higher income, maybe more exposed to the stock market, that sort of thing?
No, I think uncertainty is not good for any market. And I think you're seeing that because we're seeing a slowdown in the economy, and that's having its impact.
Where does it go from
And
here?
so, I think that the market is going to keep chugging along. I mean, I believe in the housing market because, it's a commitment to your future. And housing as an asset class is the one place where you can actually get shelter. You can't get shelter from your stock portfolio or if you're collecting art. So I think for people who want to commit to their futures, buying a home is a great place to do that. And so I think the housing market will continue, whether it's a bull market or a bear market. And, we had a really good January, as you said, but last year was not a good year. And so I think that this year will be better, maybe, but it's going to be, as Warren Buffett says, lumpy and bumpy. I don't think it's going to be smooth sailing. And, I think people are committed to the process of buying a home. We just need to have more inventory. Prices need to come down. Rates, we'll have to see what happens with them. The Fed, I think, is going to cut maybe 3 times this year, which could have an impact on mortgage rates. But the home buying process is crucial. And people are committed to it. It is still the American dream. And I believe so strongly in it. And not because it's my book, because I've seen it proven for people. It's a commitment to their future.
Yeah. I'm curious about the price point that you referenced. I mean, down 1.5% year on year. You could say maybe it's statistical noise, but do you think prices are going to dip a little bit further here in order to get activity going?
Kelly, we need that so bad. I mean, we need to get prices down. That's been the challenge, is that there's been no intersection of supply and demand because prices have stayed high. People aren't willing to sell their homes because they've locked in this really low rate. Mortgages are high. And so we're sort of, it's like people are separated. We need to get people back on the dance floor and doing business. So I think as we get prices to come down, then we can get people out into the market buying and selling. And
All right, so our next segment is going to be on the housing market. I'm going to show you guys updated inventory updated yesterday. Got a few, oh, sorry, I had you on mute, Mitch. I have a few questions we're going to go over and comments real quick. The first one is from Trevor. Thank you for the support. We got a $9.99 super chat. Appreciate you, girl. You guys know I'm on YouTube full time now. It's been freaking brutal, by the way. But this is what she's saying. This is for you and for me, Mitch. So don't monopolize the time. I want to answer too. Just kidding. All right, the analyst. All right, now this is according to her. The analyst keeps saying everything but the stock market will crash. Interesting. Do y'all think it will crash from the top 1% super rich and they'll finally wake up to this real estate fraud? I'm just going to answer that last part real quick. I want you to run with that, Mitch. I don't think anyone's going to, if someone was committing fraud and stealing money, I don't think they're going to wake up to nothing until they're caught, because that's usually what happens. They're hooked on the fraud. I mean, Think about it. I mean, they can't be happy anymore. They're living a life of lies. Do you really want to put yourself in that situation? I mean, that's not what life is meant to be. But Mitch, what do you think about this question? Do you think it will crash from the top? So I think what she's saying is like, the rich people are going to lose money, I believe.
Yeah, the answer is yes. Everybody's going to get affected, including the fraudsters. But the reality of it is, when you lose employees, your company is hemorrhaging. It's a bad sign. And the more employees you lose, the worse things get. So left hand, right hand. No matter how you look at it, if inflation kept going, the employee would have to go to that boss and say, I need more money because I can't afford to live in my home. And most people live in a modest home. So they're not asking for anything that's out of line. The problem is that the inflation did not keep up with, in other words, the salaries didn't keep up with the inflation. And that's been going on for a long time. So when you have that cycle, then you have to ask why. Why did the salaries not keep up with the inflation? Well, the inflation is a tax. The inflation is a fraud. And that is why it didn't keep up. So the ramifications of all this is the fraud must come out of the system, or the system will implode. And I hope eventually on the real estate tax side of it, that it is recognized, because there's trillions of dollars sitting there that can be fixed, as in made to go away.
Well said, sir. Shout out to P Nice. Look at his profile picture. Love it, man. I love that. P Nice, thank you for the support. Let's see here. I had a couple questions. Wanted to get into this real quick. I totally lost them. Darn it. It was some good stuff. I mean, this is just a good comment. I'm going to read a couple of these, and then we're going to go into the housing market report, and I'm going to show you guys the updated inventory. This came out yesterday. As soon as I released yesterday's video, it updated, so I'll show you guys that. The problem is that there are too many greedy bulls out there who thought there was only a pump market. I agree mostly with that, but I also think that some of those bulls knew what they were doing. And if their job was just to get you to continue to buy, then that's all they wanted to do, is just their job, and to get you to continue to buy. There was one more. Dang it. It was something Jeff. It was Jeff's comment. Let me see if I saved it. Okay, here we go. So I think what Jeff is talking about here is rate lock. Okay. But let me read this for you. So no one is talking about the 90% of homes that the Fed set on fire with artificially low rates. Okay. So people that purchased prior to 2022, let's say that. She is talking about it now. These homes will never come online, which means those homes will never be sold, even with skyrocketing unemployment. So, Jeff, I'm not trying to put this words in your mouth, but I think it's a good topic. So what he's saying is, most of those people that have the 3% interest rate with a ton of equity, if they lose their job, they're not going to sell. That's his argument. I want you to respond, Mitch, but what I would say is, if someone loses their job and they got $150,000 in equity and they can rent for $1,000 cheaper a month, they're going to take the $150,000 in equity. I know that because I've lost my job before. It's horrible. I could be wrong, but they're going to have an incentive to sell if they lose their job. And especially if rates come down to, say, in the low 5%, maybe high 4%. What do you think about this, about rate lock? And because here's the other point. During the global financial crisis, the last housing market crash, Mitch, there wasn't such a gap of interest rates. Like, pretty much everyone had a 5 to say to 4 to 7%. Right now, some people have a 2% and some people have a 7%. So I see his point. And most people have a rate under 5%. So what do you think about the rate lock?
It's all micro. And that's part of the problem when you listen to CNBC and they talk, well, we think this and we think that. Honestly, nobody should give a damn what they think. The question is, on a micro basis, how does this affect that particular family? The idea that somebody can say globally, well, housing inventory is at an all-time low. You're delusional. It's not. It's the exact opposite. And it's going to get bigger and bigger because people can't afford to live in those houses based on the fraud, which is the real estate taxes. Then you add on top of that the inflation, which comes from the Federal Reserve. So you have communities where the divergence in fraud is absolutely massive. But here's the math. So Argyle, Texas is $343,000 in outstanding school district bond fraud with a median home value of $450,000. Okay, that's Argyle, Texas. Now, Godley, Texas, much less. It's 90,000 in outstanding school district bond fraud. Here's the big kahuna. The median value in Godley, Texas is 160,000. Isn't it interesting that one is 50%, the other is 52%? They're neck and neck. It's all micro. That's the point. Everybody's got to look at the individual circumstances to get to the truth.
All right, let me throw this back up. So Jeff had a response. I think they'll sell their kidney, but you got to ask yourself this, but why would they sell their kidney? Because they need money. Get it? I'm pretty sure they're going to sell their house before a kidney if they need money. But I think they'll sell, but his point is, I think they'll sell their kidney before they sell and lose their rate. What are they going to do? So Jeff, I'm going to specifically answer that. What they're going to do is, because you're referring to people primarily that purchased prior to quantitative tightening. Okay. So those people and that was a pocket, say, of mid 2020 to mid 2022. So the 2 years, right? And the refinancing boom and things like that. But this is what they'll do. If someone, say like myself, I have a house and I have over $100,000 in equity. If I lose my job and I'm drowning and I'm worried about, getting foreclosed on, I'm going to sell my property and I'm going to cash in, and because I've learned this already, right? Because before I just spend to the end, I'm going to cash in on my equity, take the $150,000, put it right in my pocket right here, $150,000, and then I'm going to find a place to rent for $1,000 cheaper or $500 cheaper. If I can't find that, I'm going to call you up, Jeff, and I'm going to ask you to move in with you, and I'm going to help you pay your mortgage. That's what I'm going to do. That's just,
there's no doubt that 3% is extremely cheap. Sometimes you can rent the house because, again, you don't know what the micro situation is. Sometimes they could just keep the house and rent it and still get something cheaper. It's just a function of what they can afford. It's a family issue. It's a personal issue. And
to his point, though, Jeff does have a point. Mm-hmm. There are people that don't. I mean, I don't want to sell my house. I have a 2.375. I have a 2.375 on my mortgage. I don't want to sell that. My cash flow is over. It's like $1,000 a month. I've turned it into an asset, but I situated it prior to COVID, so I was already set up. I just got lucky. I honestly, I didn't even want to turn my house into a rental. I got lucky. And this is the circumstance. But I mean, Jeff does have a point, and that's been why a lot of the transactions have been low, is a lot of sellers cannot afford to sell and rebuy. But my point is, again, when someone loses their job, they now have an incentive to sell and cash in. If they have the equity, if they didn't purchase prior to 2022, odds are they don't even have enough equity to refinance. Refinance can cost 4 to 5% of equity just to refinance, and you need equity for loan to value guideline thresholds to even refinance. So I just don't want people to be hurt. Just please don't refinance. And Jeff purchased a house and paid off his whole mortgage. So Jeff has the right to say whatever he wants because he has no mortgage. He bought a house. I think he bought a house right after they did the bank term funding program. So I think he bought a house in May to June of 2023, and he paid the whole thing off. So he has no mortgage. So I can't, and his property taxes are low. And he called me and we went over the whole thing, and I tried to convince him not to. I did all of that. But I mean, it's his money. He saved his whole life, and I'm proud of the guy, to be quite frank with you. And I wish him nothing but the best. My point is, though, most people are not like Jeff. Most people can't just buy a house and pay the whole thing off. I mean, I'm older than Jeff, clearly, right? I mean, you can't see my gray hair because I shaved my beard. And I can't pay my whole house off, but I have more kids than him. I'm going to shut up. I'm going to go to the housing market. All right. It's getting really weird. So I'm going to put a timestamp at 53:20. I'm going to show you guys the updated inventory, which is right here. And let me take this off here real quick. All right. So here is the updated housing market inventory. This updated yesterday, April 3rd at 5:26 p.m. Here it is, you guys. We are now sitting at, for March, 892,561 listings for existing. This is not pending. This is active. And let's go to March of 2020. Let's go actually right before the lockdown. So right before the lockdowns, February of 2020, we had 928,000 units. Right now we have 892. Okay. But even if we looked at March, which is right here, we're off of inventory at least. And I know it was low to start out with. I know that because I'm in real estate and have been for 20 years, over 20 years. So I know that already. But my point is we have more inventory right now than we did pre-lockdowns when we add new homes. When we just look at existing homes, we're very, very close. We're about 40 to 80,000 off. And the reason that is, again, is demand is not keeping pace with the limited supply. We do have limited supply. And demand is not even keeping up with that because, again, the prices and the payments are out of control. But this did update yesterday. Let me show you guys what Florida. Florida's off the charts. Literally, look at Mitch. They're going to have to make another chart next month. This chart is not going to cover it. Look at it's at the corner of the chart right here. I mean, Florida, this is insane. Look at the trajectory. I had a bet with Melody Wright for the last year and a half. And I'm like, no, Texas is in worse shape. And I was because of the new homes. And she's like, no, Florida's in worse shape because of the speculation. And look at this. I mean, Melody's edging me out, man. I mean, Tampa's down, Jacksonville's down year over year as far as home price decline. You guys can look at Redfin right now and you can see that price decline. But this is a primary reason why she may win. The trajectory of inventory is shocking. And again, this is going back to 2016. This is way more inventory than pre-pandemic. So right before going into lockdowns, there was 129. They're at 177. And again, the trajectory is absolutely astonishing. So take a look now at Texas. Texas is here. Texas on its way up now right here. Again, historically high for Texas. We had a little bit higher ending 2024. Went down a little bit, but it's going back up. But again, this is over where we're at pre-pandemic. You guys can see that right here. So Texas is on its way as well. I want to show you guys. Let me go into MLS real quick. Now, remember, when I do my searches, and this is for the realtors, or if you're working with a realtor, this is what you should do if you want to use the math to find deals. I really kind of supersede all of this emotional stuff like, you know, barbecue, pool, how many bedrooms, blah, 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 blah. And I go down all the way to here, and I made my own my field, and I just put price per square foot because that's an easy way to do math. I go to the map and I take 20,000 listings and I turn it into 2,000 listings. And that way, because I'm a realtor and I'm looking for my own house, right? I'm not helping anyone right now. I'm not ready to do that. I'm warning people not to buy houses. So if I go and I end this video and I start selling people houses, I would feel like a dirtbag. A lot of people do that right now. They don't care what they say and do, but I care. And so I haven't, but regardless, this is how I had set it up. So all of these houses are at $100 to $100, $120 a square foot. So that tells me that there's probably wedge. So what I would do, let me just show you guys this first one right here. This was for sale for, let me show you. Let me pull this up. Let's see if this is a good house. So this is for sale for $407,000. You guys see there's a $60,000 price cut. Oh my God. This has been on the market for 377 days. It got relisted. You guys see that? The right one is CDOM, which is combined days on market. The first field is the days on market from the recent listing. It's been on the market 116 days, $60,000 price cut. They cannot sell this house. This house is for sale for $104 a square foot. That's crazy. And look at the house. It's a pretty nice house. Okay. Now, what I would do again is I would go to the Real Estate Mindset Empowerment Center. I would do my subdivision review and I would find the wedge and I would find the cash flow. But now let me show you guys a huge problem about fraud and the central appraisal districts taking a budget and then backing the budget into value. Remember, the market value, meaning the market right now, they cannot sell their house for $407. When I go to the taxes here, this house better not be assessed for more than $407. Do you guys agree with that? The appraisal district should not appraise this house for over $407 because we know they cannot sell it for $407 because this is an active home on the market. So when I go to the taxes here, let's see what it's assessed at. Okay, let's go down here. Maybe it's 407. You guys look at this. Is it 407? Is it assessed for 407? No, it's assessed for $500,299. And here is the fraud that you guys see on the screen. Now, I've and Mitch have narrowed down how they're doing this. They're doing this by using software. They have software that gives the central appraisal districts and their employees the ability to manipulate these numbers. Look at that. This house is overassessed by $500,000. So if you become a homeowner, just make sure you guys are aware that people are going to try to steal your equity. People, and that's proven. What I just showed you right there, they're stealing their future equity. My tax rate's 3.4%. That means if my house does not go up 3.4% per year, which by the way is robbed by the municipalities, then I'm losing value and my house is depreciating. Do you understand that as a homeowner? If you do, fine, go buy a house. If you don't understand those things, pump the brakes and slow down. Do not buy a house right now until you know those things. So that's the housing market report. I'm going to update the next video here, which is on new home sales rebounding And also this person's going to give us a warning about the spring housing market. But let me see if there's any questions. Mitch, any comments on the inventory surging that I just showed you?
There's more pressure coming on the housing market. And what we haven't discussed is the multifamily inventory. And the multifamily inventory is absolutely skyrocketing. They've brought so many buildings online, they can't fill them. Well, that means that those rents turn into concession rents, which means they drop them 20, 30%. That puts more pressure on the housing market because the multifamily is now competing with the housing, and then the prices have to come down in the housing. All of this is a direct result of the fraud that's been induced into the system. And like I said, the fraud is coming out of the system by force if necessary.
So, oh, Nightcry. I haven't seen you in a while. Nice to see you, buddy. All right. Excuse me. I got the video. Sorry, guys. I didn't mean to cough. That's totally disrespectful. Sorry about that. I have the video teed up here. Comment right here from Keith. Major piece. I love peace. Oh, any news on? Okay, I want to get to that comment real quick. If our dear leader, appreciate you not getting too political. I saw the passive aggressiveness. It's fine. Does not fix this tariff mess, recession by June, and worldwide by September. And I know we did a video 2 days ago where we try to explain if we go into recession, it's because of decades long of fraud, greed, and corruption, inflation, and overvaluation, and robbing mom and pop. The tariffs may push us over the edge, but 100% the tariffs are not the reason why we're going into recession. The reason why we're going into recession is arguably the Federal Reserve. So Mitch, do you want to comment on that? And then we'll watch this next video.
We've been in a recession for 2 years. It's just people don't understand because they haven't had the math. You're seeing the ramifications of that now. And until the fraud comes out of the system isn't balanced. And that's the problem. Everything is built up fraud, compound, cumulative for so long. That's why people are going to end up losing their jobs. That's why the economic cycles are coming faster and faster. And that creates instability, not just on an economic level, but it creates instability at a home environment level. None of it is good, but it is all a direct result of the fraud.
Yeah, and I would ask, I can't remember that I put that comment somewhere, but I would ask them that made that comment, do you know what Operation Twist is? If you know what Operation Twist is, I gotta give you a little respect for your comment. But if you don't know what Operation Twist is, then you don't know how recessions work and what the government is doing to manipulate the economy. And when I say manipulate the economy, what I'm saying is we should have gone in recession several times, but instead of us going into recession, generally the market or the Federal Reserve bails out the banks, straight up the banks. I don't know how else to say it. Again, the Federal Reserve owns Fannie Mae and Freddie Mac, which is the banks. So Fannie Mae and Freddie Mac own our houses. Who owns Fannie Mae and Freddie Mac? Taxpayers? Nah, it's the Federal Reserve. Federal Reserve owns our houses. Mortgage-backed security holdings. We can show them all of these things. Let me queue up this video. Let me put the timestamp here. You guys are going to be interested to hear what they're saying about the spring housing market. And if you guys can, let me know that the audio is good. I'm going to mute Mitch and I now.
In January. Supply also climbed to the highest level since 2007. That's interesting. And prices fell 1.5% from the previous year. My next guest says staying put and remodeling seems to be making a comeback here. Joining us to discuss is Brown Harris CEO Bess Friedman. Bess, it's good. I love the blouse. Good to see you. Welcome.
Thanks so much. So good to see you, Kelly. How are you?
Listen, I keep hearing this refrain as well. A lot of people feel kind of frozen, stuck in place, like they can never leave their mortgage and so forth. So how is this shaking out so far for the spring selling season?
Yeah, I think that lock-in effect that we know about has had a huge impact, and people listing their homes and then buyers not having enough inventory. So that's created this sort of gridlock, which is not ideal.
Yeah, no, I
And
get it.
so it's going to take a little bit of time.
Yeah, especially if you're a realtor where your business is kind of in the turnover. So, we can all sit around and say, hey, Home Depot, positive comps for the first time in 2 years, and people are spending on appliances and all that. But doesn't help you guys.
Doesn't help us at all. I mean, I think the new administration's potential tariffs have also created a little bit of stress in the marketplace.
Well,
it creates uncertainty.
A little surprised.
which is not good.
Is that because you're in New York, where people tend to be much more geared towards kind of the ins and outs of policy, higher income, maybe more exposed to the stock market, that sort of thing?
So,
No, I think
Mitch
uncertainty is
just, we already saw this video, Mitch, is that right?
Yeah.
Are you serial right now? So, okay. All right. Oh my God, we already saw that video. All right, well, let's just go into our next video. Instead, right after I give everyone, I'm sorry about that, guys. We're going to go to a different video, but first, I'm just going to give you an update on our Discord and Teachable real quick, because I totally butchered that. And I was just looking, someone said I was sharp. They didn't ask me if I was president, what I would do, but I'll take it. I'm in my 40s now. I'll take everything I can get. You guys know what I mean. But here, real quick, guys, I just want to give you once again an update on the Real Estate Mindset Empowerment Center. It is a teachable website. We have free courses for you. You go to the homepage, you could take it. This is the new course right here. This is every single freaking realtor that is watching this right now. If you don't take this course, you are doing a disservice to yourself, your family, and your clients. This is going to show you proof positive how to use math to help your clients. And if you are not a realtor, still take this course so you know how the math works and you can instruct your realtor. So if you guys want to go to like my products, we have a whole bunch of stuff here. All of this stuff is for free, you guys. This is digital downloads, the criminal complaint, the amendment, the subdivision analysis form. I mean, literally, we want you guys to use this. It's very, very important to us. Also, here is the update. Let me move our picture. Here's the update on the Discord. We do need more mods. If you guys want to help us moderate, let us know. After this video, I have 3 meetings after this video with moderators. One is going to be an interview with a loan officer that I want to be a moderator that is very, very good at her job, and I want to make sure she's not greedy or corrupt. Another one is the broker that I'm working with as far as a real estate broker. And then another one is from a gentleman that is helping to spearhead property taxes. So I'm really trying to get those moderators. But I wanted to tell you guys what we're trying to do. So here's the community. We want people helping people. This is obviously how to do property comparisons, how to protest your home value. That's the first seminar I'm going to hold, is how to protest the value. Seniors in distress, letter to repeal property taxes, criminal complaints, success stories, property insurance, general housing market question. Most people will probably be there. We're going to talk about retail land and industry, uniform sales tax, consulting. Eventually we'll do as well. So I have a few people interested. You guys keep emailing us, because we definitely need help. Again, that's a community for you. We want to create some type of community full of synergy and things of that nature. So again, people need to help people. So I'm going to go into our last video, Mitch, right now. And this is for real this time.
Yeah, somebody asked who owns the Federal Reserve.
That's right. That was a good one. All right. Actually, we have 2 questions. I'm going to play this ad real quick. Okay. So here's the first one. Any news on FHA loan drops? I'm not I don't have any. I'm not sure what you mean by loan drops, like the loan amount. Like if you're talking about the loan amount dropping, I have not seen that. I haven't seen anything on FHA drop right now. I've seen defaults and delinquencies skyrocket up. I'm not sure if that's what you're talking to, but I'm really sorry. I'm not sure. I have not seen loan drops. I'm not sure what that means. If you can, I want to make sure I answer your question. If ask you to get on the bottom if I didn't answer that, please, if you could. Now, Mitch, who owns the Federal Reserve?
Federal Reserve is what's called a quasi-governmental entity. And it was created, in theory, to backstop the banks from bank runs as a result of the bank runs that were happening just prior to the Great Depression. They exist and have become corrupt beyond belief because they do not care about any citizen. They only care about backstopping the banks and keeping the banks in business. There's 23,000 employees at the Federal Reserve, and yet magically no one wishes to discuss the fraud that has been pumped by the Federal Reserve into the system, and it is in the trillions of dollars. Well, they're able to do that fraud, by printing money. Then they turn around and say, well, the interest on that money has to be paid for, and they put that on the back of mom and pop. And that creates U.S. national debt plus unfunded liabilities and the interest that has to be paid thereon. And that can't be done because mom and pop don't have the money. The two purveyors of the biggest frauds on the planet is the Federal Reserve and the central appraisal districts. So that's who owns it. It is a quasi-governmental entity. They claim autonomy, yet you can't be autonomous when in fact your pure existence is based on the money that is taken from mom and pop. That's the equity stripping. They're equity stripping the value that you have in the form of federal tax dollars and local real estate tax dollars and flipping it to cover off the debt, fraudulent debt that they have created. And that's a huge problem. Then they have what's called the reverse repo market, where again, it's a machination. It's a giant circle of fraud. None of it is true, but it's all backstopped by mom and pop. And the banks can't pay it. And the vast majority of banks, that's probably close to 70%, shouldn't exist.
I want to ask a question to the viewers. Did you guys as the viewers give permission to our government to bail out banks? I know I didn't. I didn't give them. I surely didn't give Jerome Powell permission to start the bank term funding program over the weekend. In fact, when I heard that, depression hit me immediately because I understood how devastating it was. And I went through my own foreclosure in 2009 where they promised me, Ben Bernanke was like, we're going to bail them out now, but we're never going to do that again. That's what they said. They said they'll never do it again. They do it again over the weekend, over the freaking weekend. And it hurts me because I lost everything. So why did I lose everything if they just got what I lost and then they screwed everything up again? So I just want to go back to this question. Any news on FHA loan drops? So someone said that you may be talking about interest rates. Yes, interest rates did go down with FHA. And before the end of today, Mortgage News Daily is going to update and it will show, I'm 99% sure it's going to show FHA mortgage rates under 6%. You will see FHA mortgage rates in the 5% today. And again, that's because of that 10-year drop on that 10-year treasury. So
I just want to point out one more thing.
Yeah. Go ahead.
When the Federal Reserve prints money, that printing of the money means it's a piece of paper. It's not backed by an asset. And when they inject that piece of paper into the system, that becomes a tax. The tax becomes a fraud. The combination equals inflation. So when you go to the grocery store and you look at prices of food and you look at prices of what has happened to housing in the last 5 years alone, that is inflation. And that inflation was caused by a fraud. And that is now why you're starting to see the economic wheels come undone with what the market is doing now, because the fraud has to come out of the system and it's going to hurt.
Yeah, it's gonna. I mean, even if you prepared, I mean, I've been preparing this whole time, and I'm still getting hurt. All right, let's listen to this video real quick. I'm gonna put us on mute. Let me know if it's the same video, and also let me know if the audio is good. Apparently, I play the same videos. My God, that's never happened before. It's so embarrassing.
America spells out the impact to builders and products today. They say tariffs on China would be a headwind to Masco and Fortune brands, but a tailwind for Whirlpool. Flooring maker Mohawk would benefit from tariffs on Europe and Vietnam. Mexico tariffs would be a challenge for Mohawk and Whirlpool. And as we wait to find out just what tomorrow's announcement will look like, another firm is sure about at least one thing: home prices are going up. Let's bring in Diana Olick with that story. Diana?
Well, Kelly, look, as you said, we've already talked a lot about the tariff impact on builder costs, increases on imported lumber, drywall, aluminum, and appliances. Builders will pass those costs on to consumers, but prices on existing homes could rise as well. Morgan Stanley analysts this week noted an immediate impact should be fewer builds and pushing the marginal buyer into the existing market. So that new demand shifted their forecast from 2025 from their base case 2% year-over-year price decline on existing homes to closer to their bull case of a 5% price gain. Now, even before tariffs, the S&P Case-Shiller Home Price Index had been showing a reacceleration in price gains, up 4% annually in January. The expectation had been that mortgage rates would drop and resale inventory would rise. Well, mortgage rates are very slightly lower than where they were at this time last year, nowhere near where they were just 5 years ago, pre-pandemic. Also, they haven't really moved at all in the last month. the start of the all-important spring housing market. As for the supply, it is now 27.5% higher than it was at this time last year. And while that might seem like a lot, it's still nowhere near where it was in 2019, again, pre-pandemic. This is all going to come down to demand, which did tick up at least on the most recent pending sales index. And that demand, of course, will depend on consumer confidence. But again, Kelly, it's just getting less and less affordable to buy a home.
Do they, Diana, spell out if there would be any countervailing, issue technology? You showed us the concrete home the other day that would be perhaps a way of getting around these rising input costs.
Look, there are some that concrete that was 3D printed homes, and that's a very small market. And that concrete was all sourced in the U.S. And of course, I've been getting a lot of emails from very niche market building supply people who say we've got this type of, product that would offset tariffs. It's domestically made. It wouldn't have any impact. But look, the vast majority of homes are built with lumber. They're built with cement. They're built with drywall. And much of that is imported. And you're going to see those price increases.
Okay, so what she's thinking is because of the tariffs, and what I try to do is, where is it? I try to put up for you guys the new home inventory, because she's saying that builders are going to raise their prices, but they already got 8 to 9 months of inventory. They've had over 6 months of inventory for 2.5 years. They're having to give, in my market, 0% rates because they can't sell their houses as is because they're priced too high, and the prices are still going to go up. And again, what I noticed, Mitch, is listening to these people. Not a single person is telling us how people are going to pay for this. How are people going to pay for this? Real median household income's not going up, but prices are going to go up. Well, then that means, was Wall Street going to buy these houses? Is that what they're referring to? Because Wall Street's going to come in? Which concerns me, by the way. But what do you take on the tariffs being the direct reason why home prices continue to go up?
There's no nexus, right? So the tariffs, unfortunately, are necessary and a ramification of what the United States used to be. So our economy was a nationalistic economy. That's how the United States was created. When the country, through its leadership, started subbing out our culture, the American culture, what the United States was founded upon, that allowed the growth of China. China has now become the nationalistic model of what the United States used to be, where everything was produced in the United States. It is now produced in China. And you have to understand why Trump is doing what it is that he's doing, because if he doesn't, you end up as a third world country, poor. We are the biggest economic engine, and it can only be maintained by having things built on our shores, which is also good for national security. With regard to their comment, well, housing prices are going to continue to rise, et cetera, because of the tariffs. You're missing the point completely. First of all, it's, as where Travis was going a minute ago, nothing else matters but the median household income. And if you, the builders, don't even understand who your clients are, then okay, fine, close your doors because you screwed it up. Nothing else matters but the ability of your customer to be able to pay and afford that house. People aren't going to go build houses and add more inventory when in reality the buyers aren't there. So a new house, will bricks be more money? No, bricks are made here in the United States. Sticks for what's grown here in the United States? No. For what's brought in from Canada? Yeah, a little bit. But here's the point. There's a cost and nothing else matters because the value of what is going in people's pockets, their median household income didn't go up. The vast majority, and I mean the vast majority of the United States homeowners, even renters, can only afford X, then X is what will be supplied one way or the other, supply and demand.
I'm going to show some data to kind of counter what that talking head was saying. And I just wanted to remind people, let's not act like the new home builders weren't using illegal labor. They weren't giving jobs to Americans. Why? I don't know why people are like supporting new home builders when they robbed us of our jobs and made horrible houses that blow down in a heavy wind. We do, or moldy. How many moldy houses? I mean, houses are blowing down in the wind. They're using illegal labor, and I don't want to get into immigration. It's such a polarizing topic, and I lean towards helping people. Not obviously, it doesn't matter. But my point is these new home builders were using illegal labor. And not only that, they're exceeding the IPCs, the interested party contributions, and also the seller concessions aren't being removed from appraisals. And they're putting it should be illegal. They're putting they're taking people's rights away, American rights away, by having people sign an arbitration agreement in their special warranty deed. So screw these new home builders. I hate them. I hope they all go bankrupt and we get all of their houses for 50 cents on the dollar. And then someone else comes in and starts building homes the right way and gives those jobs to Americans that deserve it. Let's not act like they're not robbing us, guys. Come on. And they get our tax money. But here's the data that I want to show you. So she's saying that the prices are going to go up, but this is what I wanted to show you. They're not going up. Again, we've been at 6 months. We hit 6 months and stayed at 6 months since February of 2022. 6 months or more is a buyer's market, not a seller's market. A seller's market, maybe they could raise the prices, but not with this much inventory. And this is underreported. I know that because I've been traveling around the nation for the last 2 years with Melody Wright. So I've gone there to show you guys they got 2-3 times more inventory because all of this data is being reported with a survey. So this is not even, it's just a survey. People are talking, and it says on those surveys that only 70% of people even respond. So they don't even have all the data. But look at the data that they do have. It's 8.9 months of supply. There's no way that the prices are going up, especially when we look at, let's see here. This is not adjusted. Let me see if I can get real median household income. Okay, so when we look at real median household income, 2019, 81,000. This is not updated yet, unfortunately. Right now, 80,000. So when we adjust for inflation, I mean, literally, our wages haven't gone up this whole time. So we don't even have even if we wanted to drown in debt, we don't even have the ability. We can't afford it. And look at what Lennar's doing. This is my own neighborhood. Okay, this is in Houston, Harris County. I typed in Houston, the first home that comes up, very first home. I didn't scroll down. This is the top of it. That's a price cut of $108,000. Now, if you guys have been watching my channel, you should know that we don't know whether or not that's a true price cut of $108,000 until we do a market analysis and we review comparables, because I've shown you guys that sometimes they play tricks and make you think that they're doing price cuts when the reality is it's not a real price cut. So even though it says 108,000, what I'm saying is remember, you still have to do your due diligence. But several price cuts. Here's another one that's 54,000. This one's about 70,069. This one is 102,000. I mean, so their price cuts are heavy. And take a look at this. That's not all. So not only doing the price cuts, and that's what do you mean the prices are going to go up? You mean the interest rates are going to go down? I think that's what she meant to say. Interest rates are going to go down is what she meant to say, because the prices are having to go down. This is what Lennar's offering. On top of that, they're doing a 3.99% FHA. I just showed you guys FHA is at 6%. They're offering rates 2% under market right now, which locks people in. And if you get a 3.99% right now from Lennar, you can no longer refinance or sell. You can't refinance because there is no rate lower than 3.99. So you're stuck. You do this, you're stuck. Plus they receive a $50,000 price reduction, plus a refrigerator, washer and dryer, appliance package. I'm pretty sure no one is running the IPC, interested party contribution thresholds, and I'm pretty sure they're violating the law. And I wish someone would shut these people down. Hopefully they'll eventually do that. So again, you guys, if you want to be moderators, please email us. I'll put Mitch's email in the description. I know you like your email in the description, Mitch. And just reach out to us. We want to build a community. We want to help you. We don't want to charge you for that. I may do some paid seminars just to try to afford to keep doing what I'm doing. But as far as our education, our downloads, our courses, it's all for free for you guys. So I'm going to get everyone out of here. But Mitch, I want to give you some last words. What would you like to tell the viewers?
We're about to go into a pretty rough period of time. And as we've been pounding the table on, having an emergency fund is going to be necessary, and invest in yourself more than anything else. That's all that matters.
I love it. So I hope you guys understand What he's saying is so important. Invest in yourselves. I've been trying to tell you guys to do it. Invest in yourselves. That's why we have these free courses. Please, guys, invest in yourselves. We're trying to help you do that. The market is looking awful. I just look at futures right now. This is not going to be good today. It's rebounded a little bit since we saw it last, but you guys, we're going to get out of here. Happy Friday. If you guys can do me a favor, you don't have to, but if you can, do me a favor, especially if you're in a relationship, if you have a spouse or significant other, why don't this weekend, instead of going out and partying, I don't know if you do that, but if you do that, why don't you guys go out on a picnic at the park, bring your laptops and rebudget, cancel some subscriptions, figure out how to save money, figure out how to cut your budget down, and prepare for the worst. If you want to expect the best, you can, as long as you're preparing for the worst. Now we're going to get you guys out of here. Once again, happy Friday. Thank you for joining us. We will have a video out this evening on the Challenger Report. Just to give you guys a heads up, we have had more job cuts in the first quarter of 2025 than we've had since 2009. 2009, during the global financial crisis. You guys, we're in recession, and we're in recession right now. And other than that, again, if you guys are out there investing in yourselves, you guys already know we wish you luck, and we hope you win.